boa noite, galera! Sejam todos bem-vindos aí ao Forex! Forex! Galera, a gente vai comprar o Forex aqui no 53, 14,53. Deixa uma comprinha lá. Beleza? E aí vamos vender o Dow. Vendido aí no Dow. O stop tá aqui, ó. Aí o alvo tá aqui, ó, no Dow. Ele vai fazer uma correçãozinha aí. E o ouro, cara, ou você vende aí para sair aqui no 53, quem quiser vender. Vai ter que estopar aqui no 57, pouco. Aí a saída é aqui. O melhor compra, na verdade, é aqui, pessoal. Aqui no 52,5. Tá? É isso aí, galera. Boa noite! Vamos lá, pessoal. Vendido no ouro e comprado no Dow. Exato, aqui, cara. Ué. Ah, tá. Stop 57. Gain 53. Aí lá vai ter compra. Tá aqui, ó, pessoal, ó. SLTP.
Let's check in on the first word news now. Get over to Radhika Gupta. Radhika.
Thanks, Paul. Former White House counsel Don McGahn has been ordered by a judge to answer questions about possible obstruction of justice by President Trump, a ruling that could threaten the president amid an impeachment inquiry launched by House Democrats. Trump claims McGahn is covered by broad presidential immunity and ordered the lawyer to spurn the congressional committee's subpoena in May. Beijing says it continues to support Hong Kong Chief Executive Carrie Lam and her government despite the overwhelming victory for pro-democracy candidates in district council elections. But it summoned the US ambassador to express strong opposition to what it calls American interference in Hong Kong. A statement on the Foreign Ministry website accuses Washington of supporting violence. Uber's biggest market in Europe is at risk after regulators revoked its license to operate in London for the second time in 3 years on safety concerns. The London transportation regulator says Uber has failed to adequately verify drivers' identities and safeguard the service for passengers. At least 14,000 trips involved drivers who weren't who they said they were.
Look, I'm really keen to look into the hotbed for innovation, for new technologies, for new businesses to come, but abide by the rules. And what's clear is Uber's policies and their practices means that passenger safety is being compromised.
Global news, 24 hours a day, on air and at TikTok on Twitter. powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Paul?
All right, thanks very much, Ritika. Let's check in on Westpac after the news that CEO Brian Hartzer has agreed to resign. Westpac shares now trading here in Australia and up very modestly, about a third of 1%, but this does reverse a week of declines. We've seen Westpac shares lose about 8% of their value over the previous week, getting close to a 7-year low after this news that it violated money laundering laws, and it is accused of committing, in fact, the biggest violation of financial laws in Australian history. Bloomberg finance reporter Emily Cadman is here with the latest developments. So, Emily, it really was a case of when, not if Brian Hartzer would go, wasn't it?
Yes, I think so. I mean, though he initially attempted to tough it out, it was really clear that his position was untenable from the start. And I think today what we're seeing is bound to the inevitable. Whether he or not he knew about these things, and the fact is he was at the helm during the period when many of these violations took place, and as he said in his statement today, ultimately the chief executive officer is responsible. So focus now comes on to the recovery stage. Who is Westpac going to get to take on the mammoth task of restoring its reputation, trust, and getting to the bottom of the system faults that allowed these breaches to occur?
So, are investors going to like this?
Going to like it? I think they think it's inevitable. I mean, as the chairman said today in his statement, which he also announced he'd bring forward his retirement, this decision came after they took feedback from major institutional investors and shareholders. Many of them have been telling us privately that they didn't want to speak publicly, that they were horrified about the scale of these breaches, and they were deeply disturbed at, the allegations from the regulator that there had been indifference from senior management. So I think investors, today Westpac has taken pretty decisive action, and they're now going to be seeing how the bank restores itself from here.
Yeah, more broadly, it's been a horror few years for the banking industry here in Australia. I believe there's only one CEO of the Big Four left standing now, isn't there? How is this? What sort of damage does this do to the image of the industry here?
Well, you see, every time I come on the show, Paul, we talk about how, really the reputation of the Australian banking industry can't get much worse, and then something seems to happen to, change that view. It's been a horror year. We've got horror 3 years. We've had a Royal Commission which lambasted the sector, for widespread misconduct. We've had the chief executive officers of National Bank of Australia and Commonwealth Bank of Australia resign among various scandals. It just keeps getting worse for the bank, and what's particularly noticeable is Australian banking was lauded for so long. It got through the global financial crisis with barely a scrape, and ever since seemed flying high. It's been a very sharp fall from grace.
All right, finance reporter Emily Cadman, thanks very much for joining us, and we now have Westpac shares higher by 1% early trade. Still to come, a manic Monday of deals in the US saw Charles Schwab confirm its $26 billion move for TD Ameritrade. We'll have the details.
But up next, Alibaba makes its long-awaited trading debut in Hong Kong in a few hours. Demand is surging for a piece of the city's largest share sale in nearly a decade. This is Bloomberg.
This is Daybreak Asia. I'm Paul Allen in Sydney.
And I'm Sherrian in New York. Alibaba makes its trading debut in Hong Kong in a few hours. The long-awaited listing comes amid equally long-running popular unrest in the city, and as China pushes companies to list closer to home. Sophie Kamarudin is watching this for us, and Sophie, this is a big day for Hong Kong. Also a big day for Alibaba, 20 years on from Jack Ma starting the company with just $80,000 that he scraped together. And here, it is certainly a milestone for Hong Kong, given that the share sale could raise as much as $12.9 billion if a green shoe option is exercised. Now, that is less than the original $20 billion that was targeted, but is still the biggest listing in Hong Kong in a decade. A sign of confidence, then, for the city during the political eruptions. And more tech unicorns could be enticed to go public here after the local board's relaxed rules allowing dual-class shares. Plus, Alibaba may also pave the way for companies with such governance structures to be eligible for inclusion in the Hang Seng Index. Now, currently shares are just eligible to join the Hang Seng Composite Index. Also on the horizon, Alibaba could be added to the Stock Connect, joining Meituan and Xiaomi. And mainland funds, they are readying for that wave of Chinese money, Paul. Your first-time onshore investors making up about a third of international buyers for the offering.
Yeah, Sophie, a huge amount of interest in this. I think the retail portion oversubscribed something like 42 times. So how are shares expected to do on the trading debut?
Well, shares rose in the gray market. A solid debut expected then for Alibaba here in Hong Kong, trading under ticker 9988, which sounds like forever. Prosperous, and plenty of buyers want to get in on the action. As he pointed out, there was oversubscription of about 42 times, and that triggered a clawback mechanism to boost the retail tranche to 10% from 2.5% of the total deal. Now, the secondary listing was priced at 176 Hong Kong dollars. That's a 2.9% discount to ADRs, which are fully fungible with a 1-to-8 ratio. So that may cap the upside this morning. And ahead of the kickoff in Hong Kong, ADRs listed in New York, they did climb to a May high, and keeping then a narrow premium with ADRs implied at about 186 Hong Kong dollars per share. And analysts, they are bullish on BABA with 54 buy calls and 1 hold on ADRs. The price targets ranging from 180 to 280, with the average at 225. And going forward, guys, a lot of attention will be on what cash-rich Alibaba and CEO Daniel Zhang may do with the funds as it boosts the war chest to $43 to $44 billion. That is double what Tencent has. So a lot of focus on how the money will be put to work, Paul, such as investing in new tech or perhaps fending off rivals on the mainland. Paul.
All right, Sophie Cameron in Hong Kong, thank you very much. And we're going to have more on Alibaba's Hong Kong listing throughout the day. OCNC Strategy Consultants partner Adam Shu joins us in the next hour. Plus, Pearlbridge Partners Director Andrew Sullivan's going to be with us at the market open. Alibaba's mega share sale is a much-needed boon for Hong Kong amid all the ongoing unrest. Investors have begun weighing other financial hubs. Singapore, an obvious choice, but OCBC boss Samuel Xian says he's not seeing significant inflows from Hong Kong just yet. He told us how the protests have affected business.
Actually, the amount of capital and wealth flow into Singapore from Hong Kong is not noticeable yet. There are inquiries, I think there are interests, but we do not see any significant noticeable flow from Hong Kong into Singapore at this stage.
So you're not seeing any major shift in client investments in terms of their inquiries coming from Hong Kong?
Correct. I do not see any major inflows into Singapore. There are interests, there are inquiries.
What sort of contingency plans does the bank have in place should the situation in Hong Kong escalate even further?
In terms of Hong Kong, we do commercial banking business, we do some treasury business. In terms of the Hong Kong domestic business, we are pretty well contained in terms of liquidity and things like that, so we're not that worried. In terms of future outlook, I think Hong Kong's domestic investment will probably take a few years for them to come back to the previous level. But the most important thing is we rely quite a bit on the flow business. The flow business, we're not talking about wealth flow per se, but we're talking about trade flow from China through Hong Kong into other parts of the world. I think that may skip Hong Kong for a while and come directly. In that sense, therefore, Singapore may benefit, but may benefit as a result of the restructuring of the flow, the supply chain shifting that may happen, but I'm not focusing on the wealth flow per se.
So you wouldn't be looking at changing your business strategy in Hong Kong?
No. We still think that Hong Kong is an event, and that event thing is that it does come and it will go at a certain point in time. But I think after the event, all parties, all stakeholders will probably engage each other more and then rebuild Hong Kong. That will take maybe a couple of years, 1 to 2 years time for them to rebuild Hong Kong, but our medium-term outlook for Hong Kong and for that region continues to be positive.
S&P has also kept their rating on Hong Kong stable as well in terms of saying it still remains a viable financial hub. It seems very much like you agree with that.
Yes, I do agree with that because the ingredients of Hong Kong continues to be there. The way that Hong Kong people want to do business, the knowledge that they have on what Hong Kong's role is to serve the entire Asia and to serve China continues to be there. And I think that is quite difficult to be replicated in other countries in order to take over the role of Hong Kong.
And when we last spoke, you were talking about the Greater Bay Area being a huge focus for you in terms of business growth, profitability. Has what's happened in Hong Kong had any impact on those financial targets?
It continues to be a very promising region from our perspective. We have said, as we discussed last time, that at the time when we announced the Greater Bay Area strategy, our earnings from that particular region is about $500 million Sing dollars. We have plans that in 5 years' time, the earnings from that region is going to grow from $500 million to $1 billion Sing dollars. We're still on track on that, but remember that that is a flow business as well as a domestic business. So we are continuing to position well in that region, in the Pearl River Delta region, in Hong Kong, in the connectivity flow between ASEAN and Hong Kong, ASEAN and PRD, and within China, PRD and the northern part of China.
What about the property market in Hong Kong? Because it seems to be fairly resilient despite everything that's happening in the city.
But the transaction level in Hong Kong has come down. The price has not come down. That was because the private family in Hong Kong, the leverage is not high. And they have the ability to continue to hold on to the property without doing any fire sale. And I think that situation is going to continue for a while. Leverage low, liquidity continues to be there, people's ability to serve the debt continues to be there, but people's willingness to buy at this moment has reduced. So transaction down, price has not yet come down.
OCBC CEO Samuel Sian speaking to Julia Sally in Singapore. You can get a roundup of the stories that you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers, go to DayBgo on your terminals, also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg.
Hi, Lola. Tanto brasileiro. That's mine. Não quis comprar nada.
Well, I think there are a lot of challenges for the EU. You're pointing there to the point that people look at Brexit in terms of the EU going from 28 to 27 member states. But in terms of the weight of the economy, it's more like going from 28 down to around about 10. So this is a big limb being whacked off the EU. But the challenges for the EU really revolve around the fact that the so-called EMU, the Economic and Monetary Union, the Euro, is still really just really hobbling on one or two legs of a four-legged stool. It only has a couple there. That is the Monetary Union and now some of the Economic Union, trying to put in elements of Banking Union, but still a fair way away from being a fiscal union. So the EU, with the new Commission coming in as well, has all sorts of challenges to find out what its longer-term steady-state configuration will be. And one thing that sort of disappointed me in this whole process, the lack of strategic thinking and leadership at the EU level in terms of trying to kind of fold in the whole Brexit process to a longer-term process of, where does the EU end up as a result of this? I think there's probably been a little bit too much narrow focus on Brexit and putting a lot of the weight on the UK and making life hard for them rather than looking for win-win outcomes.
Yeah, to that point though, do you think maybe the strategy from the EU was to put pressure on the UK to really serve as a warning to any other member states that might have been getting some ideas about leaving the Union?
I think there's certainly an element of that. I think there's also been an element of keeping the option alive, Paul, that something will happen and maybe a second referendum or a vote that goes in the direction of actually the UK remaining. So I think they've been keeping that option alive. That option does seem to be dying by the day. But there's always been this narrative that the EU in some sense had to play hardball with the UK to make it clear to any other member states that this would not be a good thing to do. I've always been of the view, Paul, that that's just not the right way to think about a project that has at its heart countries coming together and sharing their sovereignty and building a larger supranational organization. You have to do that on the basis of mutual gains and benefits rather than threats of what might happen if you bolt for the door.
And of course, we have seen policymakers, especially at the ECB with President Lagarde, now trying to lobby for looser fiscal policy in the EU. Some people are saying she should refocus her lobbying efforts, perhaps better used in an actual EU Eurozone budget instead of trying to get some national stimulus from these individual countries. In their review of macro policy, as you say, could this be an alternative?
I think we're going to hear more and more, Sherry, about the need for fiscal policy, for the fiscal framework to do more of a job, particularly when growth is dipping. There is certainly room for fiscal policy to step up, particularly through the investment channel. But the challenge that Madame Lagarde has as the incoming president for an 8-year term is that the euro is a monetary union, but it is not a fiscal union. And therefore, she doesn't have one government against which to negotiate. But I think the theme of, if I were to sort of look into the crystal ball here, I think what we're going to see over the next few years under Madame Lagarde is gradually the ECB having to step up and perhaps compensate, and some would argue they've already been doing this, but compensate for the lack of a fiscal union and maybe take a broader interpretation of their own mandate. I think that the ECB has tended to interpret their mandate very, very narrowly. I think if you look at the fine print of the treaties, it's not as narrow as it looks. So I'd be looking for the ECB to be perhaps acting a little bit more as almost a quasi-fiscal entity over time. If we don't get the fiscal union, if we get the fiscal union over time, that takes the pressure off the ECB to fill in that gap.
Right. Paul, let's talk a little bit about the fine print when it comes to Fed policy. We have Chair Powell speaking at the moment in Rhode Island this evening. He's really maintained his views that rates are in a good place, although he has talked about his outlook doesn't have to suffer material reassessment. What could lead to that, given that we are now seeing some progress perhaps in the U.S.-China trade negotiations?
Well, I think that the Fed is probably in a wait-and-see mode for the moment. They've done their 3 rate cuts pretty rapidly in the second half of the year. And the economy is still in reasonably good shape. And really the rate cuts have been predicated on a bit of a slowdown in global growth. And of course the uncertainties around the trade outlook with China in particular. So taking out a little bit of insurance. But I think they will be very much in sort of data mode, watch what happens to the economy. If it sort of firms up in the first half of next year, they'll probably be on hold in the election year. But any signs that the economy is flagging, I think they will be in there with further rate cuts.
What about short-term interest rates? Because Mr. Powell keeps saying that the Fed has control over them, and yet we continue to see Fed funds unusually close to the low end of policy range. Could we see another tweak in the IOER, or interest on excess reserves, coming up soon?
Well, I don't think they'll tweak that unless they actually make a policy move, because that is essentially a policy operating variable now. But I think you put your finger at Sharon on a broader point that what's been happening with the Fed's balance sheet is really quite remarkable. There's still something like $1.34 trillion of excess reserves in the U.S. banking system, and yet because of the sort of little kerfuffles that were going on in the repo market and the money markets, the Fed has had to reverse course and start to expand its balance sheet again. Its balance sheet is back to $4 trillion. Now, they're saying this is not quantitative easing, but the interesting thing is that they do seem to be sort of navigating here without a compass in terms of maintaining control of the federal funds rate. In theory, with that many excess reserves in the system, they shouldn't really need to be injecting further liquidity into the banking system. So I'm not sure that either the Fed or anybody else really fully understands what the lasting impact is on the way that money markets behave as a result of these years of quantitative easing. The Fed has never got close to unwinding the stock of quantitative easing that it built up in the Great Recession.
The new normal, right? Paul Shear, thank you so much. Harvard Kennedy School Senior Fellow. We'll have plenty more ahead on Daybreak Asia. This is Bloomberg.
This is Daybreak Asia. I'm Paul Allen in Sydney.
And I'm Sherian in New York. MSCI will rebalance its weightings in a closely followed world index later. Chinese A shares are set for a boost, while Korean stocks may see their weightings decrease. Investors have sold out of the Kospi every day since the move was announced. Além reporter Kyunghwa Kim says the correction has further room to run. Kyunghwa, so what does the rebalancing mean not only for South Korea but also other Asian markets?
Right. Today's MSCI rebalancing marks the third and the last step of this year's weight increase of Chinese A shares in the MSCI EM benchmark index. This what it means is basically when an index is rebalanced, the ETFs and the mutual funds that track it must sell and buy the same stocks. So a lot of passive funds are gonna make adjustments at the close of this month. At the end of today's trading. So before this rebalancing, a lot of active funds have already made a pre-position for this change, and by selling the smaller EM Asia stock markets like Kospi, Philippines, and Taiwan, and have bought into Chinese shares. So foreign investors have sold Kospi shares over the last 13 sessions, selling about $2 billion worth of local shares. That has weighed in on the markets. But I think after today, the MSCI overhang will dissipate it, and the markets will focus on continue to focus on the trade deal and then hard data to see if there is any green shoots in the economy.
Well, your Chinese stocks have underperformed their Asian peers significantly over the past 3 months, and that's despite this MSCI rebalancing to include A shares. So what are the concerns? What's the outlook?
Yeah, I think without the foreign inflows, Chinese stocks might have performed much worse. And the economy is really bad condition, and making things worse. China has rising inflation driven by pork prices, and this kept Chinese PBOC hemmed in. I think the pork price is important guidance to the degree of PBOC easing, and the PBOC delivered MLM rate cut on November 5th. Once they saw these pork prices decline, and the pork prices declined for second straight week last week. So they delivered another rate cut on November 18th. So it really depends on how much the PBOC can ease more to support support the economy. So the pork price is going to be a crucial guidance to the outlook for the PBOC stimulus as well as the Chinese stock markets.
All right, Team Live's Kyunghwa Kim, thanks so much for joining us there. Just want to get you across to the news on the Bloomberg terminal. We have China, according to Reuters, considering replacing its official liaison to Hong Kong. Also a report that China is to set up a Hong Kong crisis center in the mainland. So this is really one of the first major responses we've had from China since the district council elections on the weekend that resulted in a resounding victory for pro-democracy candidates. And now this report from Reuters that China is considering replacing its official liaison to Hong Kong. We'll bring you more details on that as we get them. All right, for now though, let's bring in the Pendle Group Portfolio Manager, Amy Patrick. Amy, I just want to return to a point that Kyunghwa was making there. This is the third step of that weight increase we're seeing for Chinese A shares on the MSCI Emerging Markets Index happening today. But considering all that's happened in China over the past few months, what does this mean? Is there any symbolism here? Is it a vote of confidence in the Chinese economy, or is perhaps with the benefit of hindsight that confidence a little misplaced?
I think the reweighting is a sign of a bigger, it's a structural story, it's a longer term story. It's about the global demand, and Australia exhibits it just as much as anywhere else for a diversification in portfolio allocations. And China longer term, I think, for different investors holds different amounts of that longer term potential as well. In terms of the shorter term nature of what's going on in China, I think that there has been a lot of confidence in some indicators of the global cycle, perhaps stabilizing, perhaps bottoming. And I think people wanting to rush into China shares as an expression of that potential reflation story, the same as what happened in 2016 and then throughout the course of 2017. Personally, I just think it's a bit early for that just yet. You're not seeing those same signs of stabilization coming across in China's leading indicators. You're not seeing China's credit impulse rebound meaningfully. Now, of course, the texture of Chinese recovery this time could be a little bit different, but it's too early to call it a recovery just yet.
But we do have some important indicators coming out on Saturday, November manufacturing PMIs. A rebound is forecast. What are you expecting to see?
A modest rebound is probably likely, but I would expect that for this trend to continue, you need some bigger firm resolution on the trade deal, and that's still very elusive at this point in time. Personally, I think I'm of the view that there are more incentives now on both sides to get this trade deal done compared to when the trade talks first fell apart earlier this year, at the end of April, beginning of May, because the Chinese economy has slowed down much more since then. And also in the US, Trump is facing, his 2020 election campaign. And typically in the US, you see that the incumbent has a much higher chance of winning if he leads into the elections with a tailwind of a rising S&P 500 behind him.
So if we do see that phase one deal, the speculation is that it will include a currency pact. What would that mean for the broader markets as we get a more well-anchored renminbi?
That's a really good point, and I think a currency pact is quite likely. The consensus in the market, I believe, is that a phase-on deal will be reached at some point in time, maybe too early to say that it will happen this year, and that parts of that agreement will involve a currency pact. And a currency pact was also talked about earlier in the year as well. The shape of that is likely to be in the form of China allowing Trump to succeed somewhat in his weak dollar policy. And that's going to help both the US economy, but it's going to also be a good weak dollar anchor for the rest of emerging markets as well, and especially in Asia. Against the weak dollar backdrop, emerging market assets typically tend to do well.
And Amy, we have seen media reports now saying that China is considering replacing the official liaison to Hong Kong. Of course, we continue to see the Hong Kong issue play out. We have seen the unrest in the city affect the Hang Seng Index. Could it have broader implications for mainland markets at some point if this continues?
Of course, and it depends on the degree to which the situation continues to escalate. Although I think it's interesting, reading between the lines somewhat, that on both sides, even though the Hong Kong issue is being tied by the media to phase one of the trade deal, the leadership on both sides has been fairly
eligible to join the Hang Seng Index. That could change. And ahead of a likely inclusion to the stock index, mainly funds they are positioning for the influx of Chinese money, Sherry.
Will we see the shares pop at the open?
Well, shares rose in the gray markets. We're anticipating a solid debut here, given that demand is certainly sizzling, and that triggered a clawback mechanism that saw the retail tranche expanded to 10% from 2.5% of the offering. And ADRs in New York, they rose to a high ahead of the Hong Kong debut, bringing the year-to-date gain to about 38% and keeping a narrow premium to the IPO price here in Hong Kong of 176 Hong Kong dollars. Now, shares are fully exchangeable, so investors may also be looking for arbitrage trading opportunities. And guys, analysts are bullish on BABA with the average price targets for ADRs at 225. There's one hold and 58 buy calls on the stock, with Morgan Stanley and HSBC among the latest re-ratings. And of course, there's a lot of anticipation as to how Alibaba will spend its cash pile, which now stands at about $43 to $44 billion. So will CEO Daniel Zhang be on the acquisition trail? We also seek to maybe fend off rivals on the mainland. Paul, Sherry.
So, thank you. Joining us from the Hong Kong Exchange, also with us from Shanghai, is OCNC Strategy Consultants partner Adam Xu. Adam, great to have you with us. So, how much sense does this IPO in Hong Kong make for Alibaba?
Sorry, say it again.
How much sense does the IPO make for Alibaba?
Sorry, I didn't get the question. Can you say it again? Sorry.
So we are now seeing
Abre o olho, chinês!
in Hong Kong.
Tá entendendo que ela tá perguntando, não? Bicho velho, tapado.
Okay.
Ah, ok. Baba ovo. Comedor de ovo. Pensa direito, macho velho. Presta atenção.
And the background is the e-commerce in China has been increasingly competitive, even though Alibaba has a dominant around 50% market share in terms of e-commerce for B2C. We see Pinduoduo has been very successful, growing very fast, and also very aggressive. The recent Double 11 is a good example. It has been heavily providing discount to attract consumers. So with the new funding from this IPO, Alibaba literally has more kind of bullet or power to continue to invest in core market as well as the new areas, which are called strategic investment areas.
So how much goodwill will this IPO in Hong Kong earn Alibaba from Beijing authorities?
Já vai abrir aí o mercado aí asiático.
Any decision is very much commercial driven. If we look at the three strategic pillars Alibaba announced recently, it's very much focused on globalization, focused on continue to increase domestic consumption and capture the value from that. And then lastly, so-called big data, which is really the cloud and the infrastructure. And Alibaba continue to need to ramp up the growth in